Mr. Pearce, you have 5 minutes.
Thank you, Mr. Chairman. Before we were so rudely interrupted, I was going to ask, when I'm looking at Mr. Wagon's testimony, I see on page 1 that he says that the decision to make a loan will be second-guessed by regulators, and he goes on to make the point that regulators are a lot responsible for the failure for the loans to take place. And Professor Johnson on page 2, number 8, says to blame bank examiners for the lack of lending in a post-crisis economy makes no sense. And so I'd kind of like to drill down just a little bit deeper in that. Professor Johnson, do you have empirical evidence? I guess if I were going to look to try to figure out the difference, I would look at safety and soundness reviews and compliance reviews. That would be two vastly different approaches. One would be concentrating on the capital and whether the financing by debt or whatever, and the other one might be a regulatory approach. So in your empirical evidence, have you studied the amount of reviews now that are compliance versus those that are concentrating simply on safety and soundness? Which one is dominating in the reviews right now?
Congressman, that's a very good and a very fair question. I don't think anybody knows that level of detail on the systematic data. We do know from the Federal Reserve Senior Loan Officers Opinion Survey and from the National Federation of Independent Businesses Survey on small business economic trends, the predominant fact there is that demand for loans remains sluggish because of the damage to the balance sheet. So
I'm hearing a completely different thing, sir, in New Mexico, small banks, and I'm hearing that there is evidence that I get banks together on phone calls frequently, and they tell me that compliance reviews have replaced safety and soundness, the tediousness of it, and in fact those soundness reviews are in fact chilling the market exactly the way that Mr. Wagon describes. They in fact tell me that when they used to get simple markups, a notation, a write-up for something, now then they face $50,000 fines, and they tell me, why would I loan money on a New Mexico house that I'm never going to make $50,000 on that particular loan? Why would I risk making a loan in order to get possibly a write-up because we left a comma out or because we didn't completely fill out the flood insurance? Flood insurance in eastern New Mexico is not a high priority item. We haven't had rain since last August, and the state's burning up, as you can see on TV. And so this would lend us to believe a little bit more that the process of reviews is in fact chilling the market, exactly like Mr. Wagon said. Now, you had made the assertion in your verbal comments that why are banks scared? You asked the rhetorical question, and then you said that they have too little capital. I, in fact, am hearing from banks every day that they have plenty of capital and they have loan demand, but they also tell me that if they make one bad loan, that their bank is going to be taken away from them. They point to examples in New Mexico where that's happened. And so why would a banker risk making a loan that somebody is going to come in and review at some later time and lose their entire bank over? I would draw you to Charter Bank. I would have you look at Bank of the Rio Grande, both of which were operating fairly good until they began to come in and say, well, we're going to downgrade this or that. Very few non-operating loans. I think the next point that I'd really like to ask about is the pro-cyclical and counter-cyclical regulatory measures. Right now, I think that the regulators, and I think you could make the very strong point that they're pro-cyclical. When things are good, they simply open the door and let them get better instead of trying to check the process and instead of saying, well, let's all slow down just a bit. And when they start going bad, then they make things go worse by their foreclosures, by their insistence that they close down loans that are still performing. Then the appraisal values go down, and so builders can't get loans because the appraisal values have been abnormally pushed lower by the actions of regulators that are calling into question loans that are performing every day. We had recently a group and this is about a year ago, as a matter of fact, even before the election, we had a group of Indian American hotel owners all came in from a 3-state region. Every single one of them had demand requirements that you have to provide us another $750,000 in capital to loans that they had performed flawlessly, never missed a payment. Those feel like regulatory excesses that are simply doing what Mr. Whalen contends, and your contention, on the other hand, is that it's ludicrous to make that assertion. Would you, I tend to side with Mr. Whalen, and the evidence that I hear every day sides with him. Would you like to comment on that?
May I? Again, I think these are legitimate concerns. Certainly, regulators can become pro-cyclical, as you say, exaggerate the boom and also exaggerate the bust. And certainly there are convincing anecdotes and instances, examples. But systematically, is this what's happening? Have examination standards become tighter?
When every banker in the state says yes, because I have these conference calls, have you got empirical evidence that says it's not happening, that it is only anecdotal? I find that pretty offensive when you don't come in here with empirical evidence and you're declaring what I come with bankers saying often. I consider that to be offensive, that you're saying it's anecdotal. If you come here as a professor, you bring the empirical evidence for the claims you're going to make, sir. Thank you. I yield back.